Good day, everyone. Trust you're doing well today. Today, we're talking about the truth about Aradel Holdings and why are big investors selling. Now, imagine this for a second, right? 5 years ago, you bought a plot of land at Egbeda for just 5 million naira. At that time, many people thought you were wasting money. The area was still developing. There wasn't much happening in the area. Then something happened unexpectedly. A massive shopping mall was built right beside your land. New road also came in. Businesses started opening. Suddenly, everyone wanted land in that same area. Then one day, someone knocks on your door and says, I'll give you 50 million naira for your land. Now, let me ask you a simple question. Would you refuse to sell just because you love the land? Probably not. The truth of the matter is, many people will happily collect the money because they have already made 45 million naira profit. That is exactly what is happening with Aradel Holdings today. Many people are seeing headlines that big investors are selling and immediately thinking something must be wrong. But what if I told you that selling does not always mean bad news? Sometimes selling simply means I have made enough money. Today, I will explain why many professional investors may be reducing some of their Aradel shares, why this does not automatically mean the company is in trouble, and the biggest lesson every Nigerian investor should learn from this. Stay with me because the last lesson could completely change the way you look at stock market. Now, here's the biggest mistake people usually make. Whenever people hear that big investors are selling a stock, panic begins. Some people rush to sell without even asking any question. Others start spreading rumors like the company is finished, something bad is happening. But experienced investors don't think like that. The first question they ask is, why are they selling? Because there are many reasons someone can sell a stock. Sometimes a company is really in trouble, right? But other times the company is doing very well and investors are simply just taking some profit off the table. That is an important difference. From everything we know publicly about Aradel, the company continues to report strong business performance in Nigeria's oil and gas sector. So if the business is still performing well, now why are some investors selling? Let's look at the reason one after the other. Number one, the basket of eggs rule. Imagine you have 10 eggs. Would you put all 10 eggs inside one basket? Probably not. If that basket falls, every egg breaks. That is exactly how professional investors think. They never want one investment to become too big. Let's use some numbers. Imagine an investment company has 100 billion naira. They have a rule. No single company should be more than 10% of all their investments. So they buy different companies. Everything is balanced. Then Aradel starts growing very fast. Its share price keeps going up week after week, month after month. Before long, Aradel is no longer 10% of their portfolio. It now becomes 20%. The company has become too big compared to everything else they own, right? So what do? They will sell some shares. Now, not because Aradel is bad, not because they hate the company. They sold because they want to bring everything back into balance. This is called portfolio rebalancing. It sounds like a big financial term, but all it really means is putting your eggs back into different baskets. That is something professional investors do all the time. Number two, when the price runs faster than the business. Now let's imagine something else. There is a small supermarket in your area. Last year it made 10 million naira profit. This year business improves a little. Maybe it now makes like 12 million naira profit. That is good. But then people become excited. Now everyone suddenly wants to buy the supermarket. The price people are willing to pay jumps from 100 million naira to 400 million naira. Now ask yourself, did the supermarket suddenly become 4 times better? Not really. The business improved quite alright, but the price improved much faster. This sometimes happens in the stock market. A company's business can be growing, its profits can be increasing, but the share price can rise even faster. Some professional investors then look at the numbers and say, this stock is becoming expensive. Notice something important. This does not mean the company is bad. It simply means some investors believe much of the future growth has already been reflected in the share price. That is why some decide to lock in their profits. Number three, don't wait until the party is over. Now let me paint a different scenario here. Remember the game called musical chairs? The music keeps playing. Everybody walks around the chair, kind of, dance around the chair. Nobody knows exactly when the music will stop. Now, the smartest players does not wait until the music stops before looking for a chair. What they do is they're already paying attention, very very rapt attention, and they're already scanning around and moving closer. The stock market works in similar way. Professional investors know that after a very big rally, buying usually begins to slow down at some point. Nobody knows exactly when, but everyone knows it will eventually happen. So some investors will decide to sell while there are still so many buyers in the market. That way, they can easily find someone willing to buy their shares. Now, if they all wait until everybody decides to sell at the same time, it becomes much harder. Again, this is not fear, this is not panic, it's simply planning ahead. Now, that's what is happening with Aradel. So, one lesson many new investors never learn is this: professional investors do not fall in love with stocks. They fall in love with good returns. Think about it. If another investment now gives them a better opportunity, they may move with some money there. That doesn't mean the first company has become bad. No. It simply means another opportunity looks more attractive at that moment. That is how money moves around the market. So, what should you do? This is the question everyone is asking. Should I sell? Should I buy more? Should I do nothing? The truth is, there is no single answer that fits everyone. It depends on your own financial goal, how long you plan to invest, and how much risk you are comfortable taking. However, there is one strategy that many investors use after a stock has risen strongly. Some people call it taking out your capital. Let's say you invested 1 million naira. Over time, the investment grows to like 3 million naira. Some investors will decide to sell 1 million naira worth of shares. They will recover the money they originally invested. Then they'll leave the remaining still invested in the market. Why do they do this? Because even if the market later falls, they have already recovered their original money, which is their capital. And if the market keeps growing, they will still benefit from the remaining investment. Is this the only strategy? No, right? So some investors never sell. Some keep buying during market corrections, and other takes profit regularly. The important thing is not copying another investor, all right? So the important thing is understanding why you are making your own decision and why you are making it at that point in time. So the big lesson from Aradel is whenever you hear that large investors are selling, do not panic. Instead, ask yourself one question: why are they selling? Sometimes it's actually because a company does have problems, all right? And other times it's simply because they have made excellent returns and investors want to lock in some profits. Those are two completely different situations, right? The stock market is not just about buying good companies, it's also about understanding how people think, understanding how money moves, understanding that price and business performance are not always the same thing. A company can continue doing well while its share price moves up, down, or sideways. That is why successful investing is not about following headlines, it's about understanding what is happening behind those headlines. Now, if there is one thing I want you to remember after watching this video, it is this: a falling share price does not always mean a failing company. Sometimes it simply means early investors are collecting the reward of being patient. Your job is not to copy what big investors do. Your job is to understand why they are doing it. Once you understand the reason, you can make better decisions, right? Instead of reacting out of fear. Now, if one of your stocks double tomorrow, would you take some profits or would you continue holding? I would love to hear your thoughts in the comment section below. Something else, if you're looking to get regular stocks recommendation and stock market tips for both Nigeria and US stocks, I have a Telegram channel where I share frequent market insights to enable you beat the market. So if you're interested, indicate your interest by sending me a mail via the email address in the description box of this video. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.